So can you see the screen now? There's a site
Yes, sir.
called these bonds. Okay, fine. Okay. Now you can see, this is a government bond. Okay, a benchmark bond, which is giving you a yield. Currently, the yield is close to about 6.5%. Okay. Now this bond was issued at a coupon rate of 6.33%. Currently, it is selling at the YTM is coming 6.5. Okay, as we have seen here, I'll just show you here. It is given here. This bond is currently, this is a 10-year bond, which is called a benchmark bond. Why it is called benchmark? I'll just share with that. Now the government can issue bonds for 2 months, 3 months, 10 months, 1 year, 2 year, 3 year, up to 40 years. Now this is a 10-year bond. Now we always take a 10-year bond because when we have to compare it with the equity and other financial market, all the data is available for the last 10 years. So that's why now, of course, this was now data is available for even more than 10 years, but we always take 10 years as a benchmark so that we can compare it with the returns of the equity market and other financial markets. So that's why the 10-year bond has become a benchmark bond. Now government issues these bonds every Wednesday, through RBI. So RBI basically auctions these bonds in the market on every Wednesday. Okay. And it is to the tune of about 12,000 to 15,000 crores of bonds they are selling in the market through an auction process. Okay. So now tell me, what is the amount of money which the government is raising per week? 10 to 15,000 crores the government is raising. Okay. And every Wednesday, the government comes and issue these bonds. And these bonds are, generally being subscribed everywhere, world over. Of course, the main people who buy these bonds are financial institutions and banks because they are supposed to buy them because all these banks are supposed to invest in government securities. So there is a RBI, a norm. So they have to buy. Even, individual investors, they can buy. Of course, we always buy them through the help of a mutual fund because the mutual fund is going to buy and we are going to replicate the return given by these bonds. Now, these bonds, I told you, the government is coming and issuing bonds at 15,000 crores per week. Now, how do I know this number? Because, every budget, when a budget is announced by the finance minister, who is the finance minister now? Mahalakshmi? Ashwin? Are you there? Are you there? Are you listening? Am I there?
Sir, you are in the meeting.
Huh?
You are there in the meeting, sir.
Okay. No, but we are all there. Okay. Now, what I was saying was that who is the finance minister, Shrishti, currently?
Nirmala
Okay.
Sitaraman.
Now, she presents the budget every year. Okay. Currently, she's presenting from last so many years. Now, every budget, we find that there is a certain revenue which the government is going to get, and there is some expenditure which government is going to incur. So, from where the revenue, government gets the revenue, government where the money comes to the government from as a revenue.
So taxes and then bonds which they borrow.
Of course, first is the taxes. Okay. The important source is that, the GST collection, the income tax collection. Okay. And they have certain companies which are, like Indian Railways, which are owned by government, and their government has invested some money into certain companies. So they give all that money to the government. Okay. So government get that revenue from that sources. Now government is going to spend on education, on defense, on whatever sources. Okay. Road building, infrastructure. Now, we always find that there is a gap between the income and the expenditure. Now, tell me, is the government income more than the expenditure, or the expenditure is more than the income normally?
So normally expenditure is more than income
Yeah,
in
so
India.
that means the government is having a budget deficit. So each government in the world they all are having a budget deficit. So most of the time, the incomes are less and the expenditures are more. So that is called the budget deficit or the fiscal deficit. Okay. Now, government, how they meet that deficit is by issuing bonds. So Nirmala Sitharaman, when she announces the budget, right at the end, she says, this is the income, this is the expenditure, and this is the deficit. Okay. And then she'll say, this is my borrowing program for the next year. It is going to be 8 lakh crores for the entire year. So that's a deficit. So we are going to, raise 8 lakh crores through issue of bonds, which can have duration of 3 years, 5 years, 10 years, or 40 years, whatever. Okay. So, and it is going to be, about, 6% of the GDP. Now, she announces a number. Okay. Now, the moment the number is announced, the stock market reacts. Either it goes down or goes up drastically. So there's a lot of fluctuation which happened after the announcement of the borrowing program. That means if the borrowing program is less and it is lower than the GDP number, which the target is close to about 5%, and the government achieves that target, then the Sensex reacts positively. If you borrow more, okay, because borrowing can be inflationary, okay, that means you're printing money. So, which is a bad news for the country, and the stock exchange tanks. Okay, so the last number which the government announces on the budget day and which have a great, effects on the budget, okay, or the markets. And normally when they ask all the, industrialists like Ambani's and, Tata's or Birla's to rate the budget. So it all depends upon how much the money is going to be raised by the government. If the money is less, it's good. Suppose you borrow more, because your income is enough to take care of expenditure, you don't have to borrow, so then that's a good situation. But if you borrow more, then it is not a very good situation. Okay, but we have to borrow, okay, because we have to grow. So if we have to grow faster, that means the government needs to borrow. If it doesn't borrow, then it has to raise the taxes, which will not be good for the people. So if you have to grow and become, grow your GDP at a higher number, then you need to borrow. Okay. So borrowing has become a good word rather than a bad word, because if, somebody has to grow, he has to borrow to, have a leverage impact and increases, all kinds of other incomes. So the government borrows and the market reacts. So now, I'm just taking you to the place. So government borrows money every week on every Wednesday through RBI. So every week, a coupon rate is decided on the basis of the current YTM. The current YTM of a 10-year bond, which was issued somewhere in, say, for example, January this year, which has been taken as a benchmark bond and which was issued at 6.33% coupon rate. Currently, it is trading at 6.50, which means whenever the government comes and raises the bond fresh, it has to offer this coupon rate. It has to offer a coupon rate which will be, very near to this this rate 6.5, which is the YTM. Okay, because currently the rate of interest is 6.50. So that means the current coupons which the RBI is raising, issuing to the public or to financial institutions. So they are making a coupon rate close to 6.5. Okay. But actually this bond had a coupon rate of 6.33. So the bond has gone down. 100 rupees bond is today trading at around close to about 98 rupees. So this bond is trading at 98. Okay. Because the coupon rate was 6.33 and interest rates have gone up in the last 6 months, and which has resulted into the fresh coupons being at 6.5%. Is it clear? Now let's see the trajectory of this rate. So we go down a little bit below and see the trajectory. So this is, the graph of the bond. So on the horizontal axis, on the x-axis, we have the time, and on the y-axis, we have the rate of interest, the YTM. So currently, the YTM is close to about 6.5%. Can you see that, Srishti?
Yes, sir.
Now, just look at this graph and tell me whether the interest rate, this is a 1 year period, okay, 1 year. Now, look at and tell me in the recent times, in the last 6 months rather, out of the 1 year, what has happened to the interest rates? Have they gone up or gone down? Or last 1 year? Just tell me, what you can make out of the 1 year period, whether the interest rates have come down in the country or gone up.
So they went down till June 25, and then slowly have been rising
Slowly have
again.
been rising again. Yeah, absolutely. So, then they started rising here. So in this period, if anybody was holding bond, he was losing money. Okay. I mean, of course, his plan was to sell, but if his plan was to remain invested till maturity, he's not going to make any loss. Okay. But here, if he invested here, then he's still sitting on some profit because the bond prices have been coming down. Suppose you made an investment a year back, then, of course, now the bond prices have again gone up. Okay. And the interest rates have gone up. So the bond price have gone down. And of course, last month or so, we have seen the interest rates are coming down a bit again. Okay. So it has gone up to, 6.6 and now it is 6.5. So there is some kind of a downward movement happening in the last a month or so. Okay. So is that clear? So now if suppose we say, we can even set a time. Okay. We can just say, 2000, 2023. So let's see a broader period. Now tell me, Shishti, what has happened in the last 2 years? Is it a good news or bad news for India?
So it has gone down overall, the interest
Interest
rates.
rates have gone down. Basically, we see that there is a lower trajectory which is coming. So it's a good news for India because government is able to issue fresh bonds at a lower coupon rate. Of course, there was some blip which has happened in the last October or so, but overall the trajectory has been down over the last 2 years. If the interest rate goes down, it's not only good news for the government, it is good news for the corporate world also. Because if the interest rate goes down, the corporate world can also raise money at a lower rate of interest. If the government is borrowing at 6.5%, then like Reliance can borrow close to about 7%. Because if the government says this is a risk-free rate, then a person, if he's told that, somebody can give you 7.5%, a company like Reliance, which carries some risk, so the person is willing to buy the bond at 7.5% of the Reliance. Okay. So even the corporate wants that this rate should go down. Because if this rate goes down, then cost of doing business becomes cheaper. The cost of capital becomes cheaper. Okay. But if the rate becomes more, then the cost of capital goes up and it's not a good news for the economy. Is that clear, Shrishti? So what
Yes, sir.
happens when the rate of interest goes down? Why it is good for the economy?
So it's good with the economy because it gives a boost for investment also, in the sense that corporate companies can also offer bonds but at a lower cost of
Yeah.
capital,
So yeah,
so that makes
yeah,
them more
absolutely,
profitable.
absolutely right. What you have got it on track basically. So everybody wants the rate of interest should go down. Okay. Now this is the bond of India. Okay. Now we will see the bond in America and other countries also. But look at this, example, the 10-year bond, 1 week, 1 month, 6 month, 6 months and 1 year. So it is giving you a trajectory. Anyway, we have already seen the bond graph. So it is no point going here. Okay. So this is, giving about, from 2015 to 2025, the what was the rate of, the yield in 2015, Shrishti?
Seven point seven five
And what
eight
is the
percent
current yield?
Six point
So
five zero
overall, if you
six.
see the rates of interest have gone down, but which year was the lowest yield, which was the best time?
Twenty to
Huh?
21. So it's 2020.
2020, the period was very good, a golden period when the interest rates came down and it came down to 5.89. Okay. So because the interest rates keep changing, so but still, if you look at 10-year track record, we have done well. Okay. Then it started going up again, from 2000. 20, and then, went up to 6.5, 7, 7. Okay, maybe, that was the time when, there was a COVID, and, maybe whatever the reason. So we have to look for that. Okay. And because after the COVID, what happened was that government has to, increase its borrowing program. Okay. To meet the requirement of the government, because, the revenues had fallen, the income tax collections had come down, GST has come down because there was lockdowns and other things. अभी लॉकडाउन भी समझ बोलने के लिए टाइम लगता है because we don't remember there's a lockdown which happened, so it has gone out of our memory. So there's I mean lockdown everywhere. So government, nobody was making money. So then the government has to raise more money. They have to jack up their borrowing programs. So which led to a higher interest rates, and the yield had gone up. So that was the reason. Okay. So there was a valid reason because it happened only because of the COVID. Okay. So now let's go here. There's one more, I'm going to show. So can you see something on the screen? Ex-
Yes, sir.
Excel
The
sheet.
Excel sheet.
Now, this sheet I had prepared during my own knowledge quite a long back to understand this phenomena. Okay. Then I'll just, okay. Now, suppose, there are bonds issued by the government, okay, for 20 years, 10 years, 5 years, 3 years, 2 years of money. It's a very good statement. It will take just 5 minutes to explain. So you invest in this bond for 20 years. So you pay 100 rupees to the government, and you start getting the coupon, which is 9%. So you'll get, up to 20 years. In the 20th year, you're going to get 109. So in 2040, you're getting your money back. And this example started in 2021. Okay, fine. And then there is a 10-year bond. Then there's a 5-year bond. There's a 3-year bond. There's a 2-year bond. There's a 1-year bond. Okay. Fine. And each carries a coupon rate of 9%. I'm going to share this Excel sheet very shortly with you. Okay. So I've just put everything in order here. Okay. Now, let's take the 20-year bond. Okay. Now, what is the coupon rate of the bond? 9%. So bond
9%.
was actually valued at 100 at the beginning. Now, what happened was that coupon rate, the interest rate came down to 8% in the market, say after a year or so or whatever. Okay. What will happen to the bonds? It will go up or go down.
Go
So it
up.
has gone up to 109.82. Okay. So how do I calculate? I just go to the formula. Okay. I just go to the formula here. Just delete it and go to the formula and do what? Uh, NPV.
NPV.
NPV. Is it? And pick up 8% here and then choose all the values. Okay. To find it. So you have to take a value starting from the first year, not the $100, and calculate the present value of all the 20 years and calculate. So it comes to 109. Okay. So that means if the interest rate drops down from 9% to 8%, say the first year itself, the value of the bond will go to 109.82. Is that okay?
Yes, sir.
Now, which means it has gone up by, 9.82. Okay. 9 rupees 82 paisa. So maybe that I need to. So it has gone up by 9.82 percentage. Is that okay? Now look at 10-year bond. Same 9 to 8. What is the change in the value from 100 to 106? So it has gone up by 6.71%. So a bond which has a higher duration, assuming the duration is equal to the number of years, so a bond is having a higher duration will be more sensitive to the interest rates. A bond which is lower in duration will go up by only 7%, 6.7%, whereas the 20-year bond has gone up by close to about 10%, 9.82%. Similarly, a 5-year bond will react less. It is less sensitive to the interest rate. So it will go up by only 4%. A 3-year bond will go up by 2.5%. And a 2-year bond will go up to 1.78%. Is that clear? So this fact explains that the
Yes,
bond
sir.
which has a higher duration is more sensitive to the interest rates. And the bond which is less, having a low duration, is less sensitive to the interest rate. So a low duration bond will change by, say, for example, maximum, suppose the low duration is having a 2-year period. So it will go up by only 1.78% with the decrease of interest rate by 1%. But if you have invested your money in a high duration bond, then it may go up to 9.82%. Is that clear? Then
Yes,
if you
sir.
just check the other way around. Now, if suppose the coupon rate, instead of going, uh, you know, uh, 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 down, it has gone up. What will happen? This bond will go down. The price of the bond will go to 91. So that means it has gone down by 8.5%. So a 20-year bond has gone down by 8.5%. A 10-year bond will go down by 6%. Okay. So likewise, a 2-year bond will go down by only 1.5. So which bond is safer? A 2-year, a 20-year or a 2-year bond, which is less volatile, I will say rather.
Shorter
Yeah,
duration.
shorter duration. So suppose if you don't have any kind of a view about the interest rates, but you think the interest rates can go either way, then it always makes sense to invest in a low duration bonds. But if you have a clear idea that the interest rates are going to go down, okay, in the future, so where are you going to put your money? Low duration or high duration? Because
High
they are more
duration.
sensitive to the interest rates. Okay. Now, there is a formula for checking this. Of course, this was my own homegrown way of doing it. So, I just checked it with the formula of duration or modified duration. Now, think that this bond, started in 2020 and maturity date is 2040. Okay. Fine. And the coupon rate is 9%. And now the interest rates have come down to 8%. So I want to calculate the duration and modified duration. Now, modified duration is actually nothing but what will happen to it tells you the sensitivity of the interest rate and the bond value. If it's saying 9.6, which means that 1% change from 9 to 8 will lead to a 9%, 6% change in the value of the bond. It is coming very close to what I have calculated here, 9.8. Why there is a difference, I'll explain that, but it is coming 9.6. Okay. So how do we do that? So we just put our cursor here and use the formula here. Go to the recently used formula, go to duration first. Let's calculate the Macaulay duration. So first we have to pick up the settlement date. Okay. So settlement date is this. That means that when the bond started. Then the maturity is this. Okay. Then the coupon rate is this. And the current yield is 8%. That means currently the bonds are being issued at 8%, which were issued at 9% earlier. Okay. And yield has come down to 8%. And the frequency is that the bond is giving interest after every year. Okay. So if the bond is giving quarterly, half yearly, then the frequency can go up. But normally we'll keep the frequency 1. So it will be 9.6%. So this is this number which we have calculated. I think we calculate duration. Okay. M duration. Okay. Now, if we have to calculate just the duration, then we just pick up here and pick up the duration here, which is the Macaulay duration. Okay. Which is take again this thing, go to maturity here, go to coupon here, and go to yield here. Okay. And put 1 in the formula and okay. So it will tell you the duration. Okay. So which is 10.37. So duration of the bond is 10.37. That means in how much time the bond pays its principal plus interest. It pays the full face value. How much you have invested, in how many time frame you're going to get your money back. Okay. But anyway, the most important is the modified duration, which tells you that 1% change can lead to how much percentage in the value of the bond. So it is giving you 9.60. Okay. Now It is not exactly matching with the number, but slightly very near to the number. Is it okay? Have you got it now? Srishti, any questions, please? Have you followed?
Yes, sir,
Okay.
understood.
Now, just before I'll have a small break again, but I'll tell you that why, my numbers are not matching a little bit. Why there is some kind of a change. So I'll just show you that. Are you able to see on the screen? Are you able to see my slide, please, Srishti? Mahalakshmi?
Yes, sir.
Okay. So 5 minutes more, and then we are going to have a break. Okay. So Mahalakshmi, can you read this?
Yes, sir. Inverse relation between interest
Okay, just
rates
hold
and
on, just
bond
hold on.
prices.
First read this.
Inverse relation between interest rates and bond prices. If the interest rates rise, bond prices falls. If the interest rates falls, bond prices rise. And if we expect the interest rates to fall in future, we should invest in bonds and sell them after the interest rate have settled at a lower rate to earn capital gains. If we expect the interest rate to rise in future and you hold bonds, either sell them immediately or hold them until maturity to avoid any capital loss. So banks must mandatorily invest in government securities to meet what's known as statutory liquidity ratio. They have to classify these securities either as HTM or
Okay.
AFS.
Now, what happens is that this phenomena has told you that if the interest rate rises, the bond price falls, and if the interest rate falls, the bond price are going to rise. Now, the best time to buy a bond would be when you expect the interest rates to fall. If you have a clear, view about the bond prices, the interest rates, then only you should be buying these bonds. Now, banks, they have to, necessarily invest in these bonds because of certain ratios which they have to comply, like SLR ratio. So, which says that the bank must buy the bonds. Okay. So, you can just check the SLR ratio. So, what is the current SLR ratio? Just go and check. Mahalakshmi, just go to Google and find out what is the current statutory liquidity ratio.
So it says
It is
18%.
18%. So, I am also checking that. Yeah, it is coming as 18%. Yeah. So that means the banks need to invest, some part of the money, and 18% of the money they have to, if they get 100 rupees with them by way of deposits, so they must put 18 rupees into government bonds. Okay. So government, these banks, they buy bonds. Now, when they buy bonds, they can either buy bonds because if they as an investment, or they can buy these bonds if they want to hold till maturity. Now, since the government, these banks have to buy these bonds to meet out the statutory liquidity ratio, so normally they will be buying these bonds because their intention is to hold till maturity. Okay. But sometimes the banks also feels that the interest rates are going to go down, and they'll be making some money because of the appreciation of bonds. Okay. So they have a treasury department. Okay. And normally, these banks, they look for people from the campuses to manage their treasury department. Okay. Whereby, the person who looks after the treasury department, he takes a decision. Number one, how much he should buy to meet the RBI SLR ratio requirement, and how much he should be investing, whether he should be investing in bonds to earn some kind of a return. So, when he is going to buy these bonds, when he expect the interest rates to go down. So, when he buys it for the purpose of SLR ratio, it is called HTM, held till maturity. But when he buys, to make money, it is called AFS, which is available for sale. That means banks generally classify, their investments into government bonds into two categories. Okay, just read this.
If classified as HTM mark to market losses are ignored, but if held as AFS mark
No,
to
no, just
market
read it from the first
losses
slide.
or
Read it
gains,
from the first this thing. Banks must mandatorily invest.
banks must mandatorily invest in government securities to meet the SLR. They must classify these securities either as HTM held till maturity or AFS available for sale. If classified as HTM mark to market losses are ignored, but if held as AFS, mark to market losses or gains needs to be
Okay, now
accounted
this is
for.
a very important statement. Shrishti, are you back? I think. Huh.
Yes,
So
sir.
now, tell me after reading this particular slide, what does it mean? Okay. Now, I'm just going to explain and just tell me that whether you have understood. Now, banks are required to put their money in bonds because it is a requirement of the government. Because they have to meet the SLR requirement, because whatever they get money from the public in form of deposits or whatever, so they can't give all the money as loan. So they have to invest in government bonds to protect and make the bank more healthier. Okay, so I think somebody's mic is on and I can hear some noise. So the banks must classify these securities. Either they are buying because they have intention to hold them till maturity. In that case, even if there is any fluctuation in the bond price, it is not going to matter them because they are going to hold till maturity. But sometimes the bank invests them for making some capital gains. If they think the interest rates are going to go down and they're going to make some capital gain because the price of the bond will go up, and then they will sell and they'll recognize that profit. Now, if they have classified these investments at HTM, then any mark to market losses are ignored, which means if the interest rate goes down and it price goes up, or if the interest rate goes up and the prices go down, then they're suffering some losses, isn't it? So those losses is not accounted for because the purpose was to hold till maturity. So any mark to market losses, that means with the interest rates changing in the market, so the bond values will go down. So they don't have to recognize these bonds at the current market value and recognize the loss which they have made and show them at a full value of the face value in their balance sheet. But for those bonds which they are holding for available for sale, that means they're holding as an investment asset, they must recognize the losses or gains in their balance sheet. That means if the interest rate goes down, so they have made money, so they must say that they have made money and recognize that as a profit in their bottom line. Similarly, if instead of the interest rate going down, the interest rates have gone up and they have suffered a loss because that asset has been recognized as after for sale. In fact, they might or may not have sold those assets, but that mark to market losses needs to be accounted for in their balance sheet. That means if the bond values have come down, they must recognize the lower values and account for the losses which their unrealized losses needs to be accounted for. And similarly, the unrealized gains needs to be accounted for. It is not only when they sell or buy, ultimately, then only they are going to recognize those losses, but every year for those bonds which they're holding as available for sale, they must account for mark to mark losses or gains. Have you got it? Any questions there? Srishti, Ranjana? Huh?
Understood, sir.
No, sir, no
Understood.
You got
question.
it, na? What I wanted to say. Okay. So now, the thing which I wanted to explain was rather this. Okay. Okay. Shrishti, can you read this?
Yes, sir. Inverse relation between interest rates and bond prices. Duration is a linear measure of first derivative of how the price of a bond changes in response to interest rate changes. In general, the higher the duration, the more sensitive the bond price is to change in interest rates. As interest rates change, the price is not likely to change linearly, but instead it would change over some curved function of interest rates. Convexity does not assume the relationship between bond value and interest rates to be linear. Convexity is a measure of the curvature or second derivation of how the price of a bond varies with
Okay, now
interest
what
rate.
this slide says is that there is no linear relationship. If suppose there is a 1% drop in interest rate, it will go up by so and so percentage. Okay, so because actually there is a curvature relationship. So the price of the bond, as per when we calculate, you know, the actual price will be the red one. Okay, but when we do our estimate, we always think that the bond price will go up, because if the yield falls or yield rises, the bond prices will now. There's this relationship between the P1, P2 is the price of the bond, and Y1, Y0 is the yield. Okay, so this relationship tells you that the interest rate and the values of the bond, they are not linear. Okay, they are curvature, because it doesn't mean 1% will lead to about a 10% fall, or 1% interest rate going down. It will not lead to 9.5% going up. It may be a little less. Like when we calculated here, we are not going further into this. I'm just going to just tell you that here we found that the modified duration was 9.60. Okay. Whereas maybe that when we calculated that there's a linear relationship. So that means there'll be 9.82% increase in the value. Whereas the bond always show a linear relationship, and the value may not go up to the level what because in our Excel sheet calculation, we assumed a linear relationship. Is that okay? Have you followed now? What does it mean? Okay, so
Yes.
now another short break. It is 12:13. So 12:30 we meet again for the final session for half an hour. Okay.